Good afternoon, everyone. Well, actually, good morning. I see many of you joining us from North America and South America. It's really a pleasure to have you here. We can start. I see we have more than 40 attendees, so let's get started. My name is Gabriel Sabato. I'm the co-founder and CEO of Wiserfunding. I'm sure many of you already know who we are and what we do, but for the ones that don't, we are specialized in credit risk assessment and risk management for SMEs and private firms. And I will be your host today. So it's really a pleasure. And the fact that so many of you have joined us today is just a demonstration of how important is the topic that we have chosen today. Is the credit cycle turning? Are we going to face a recession? I guess this is now on the mind of everyone. And we're all wondering what's going to happen. So we have a fantastic panel today, but just before I introduce them, let me just set the scene. I'm going to show you just 4 pictures. And hopefully, this is going to just give you an idea of what we're going to cover. A little teaser, I would say. This is a nice picture, the cover of The Economist of just 3 months ago. And what's actually really remarkable here is that only 3 months ago, this was a question. So is the market going to crash? That was a question, as you can see there. Well, we know now, after 3 months, that is not a question anymore. NASDAQ is down almost 30%, S&P 500 almost 20%, Dow Jones 15%. So I guess that's not a question anymore. And the same is true also on the private side, where we see a lot of valuation going down, liquidity drying up in the VC and private equity world. So it's a little bit of a common theme that we're seeing there. But let's just address the elephant in the room. Inflation. We're actually facing the sharpest increase in cost of the last 20 years. And you see a 7% there. We are almost at 8% in the UK, and the forecasts expect us to be at 10% after the summer. So very sharp increase in costs. It obviously affects life of everyone on the consumer side as well as companies. So revenue forecasts are down, profit margins are down, and obviously this is something that central banks are now trying to fight. But because of the uncertainty created by the pandemic, obviously that has been a little bit delayed. So now we're starting to see interest rates going up, but probably hasn't been fast enough, let me say. So we will need to see what happens in the next months. But obviously with this environment, the next thing we can expect is almost a perfect storm. And you can see there, costs going up, revenues going down, cost of funding increasing. Well, obviously, that's a perfect mix to drive up bankruptcies, defaults. And you can see the picture here. In the UK again, you can see that we are at basically the highest level of the last 10 years. Only a couple of times in the last 40 years, we went above this value now, and both times we were in recession. This would be the kind of amber bars that you see on the graph. So obviously the question is, where did that line going to go? And how bad can it get? And then let me close with one of my favorite graphs, the one at the bottom, showing you basically bank loans to SMEs. As I mentioned at the start, we're specialized in SMEs and are helping a lot of lenders to fund SMEs. And as you can see, obviously, the amount of bank loans to SMEs has dropped dramatically. You can basically say that banks have vanished that market. Well, obviously, that's not a great news. We know that during the pandemic, a lot of governments, including the one of the UK, put in place help for companies, and that was a way for banks to get more comfortable in SME lending. But obviously now they're basically leaving that space. We can see that as a negative point as well as a positive, and we'll hear more from one of our panelists later, because obviously with bank withdrawing from that market, we are kind of returning to normality. So more space for non-bank lenders. So that's the picture, that's where we are. And obviously, I guess there are some unequivocal signs that we are potentially heading towards a recession, but we have different opinions, even within our panel today. And so let me start introducing our panelists. I'm really pleased, again, obviously, to have Professor Altman, Professor of Finance at New York University Stern School of Business, and obviously co-founder of Wiserfunding. Julie Miecamp, Managing Editor of Reorg Europe, and Vlad Kartavtsev, CEO of Extra Consulting. An amazing panel today to discuss and basically share their views on what's happening to the credit cycle and the economy. We'll now start with Ed. Every presentation will last approximately 15-20 minutes. We'll try to have some questions at the end, but please, let's keep this interactive. You have a button there, you can ask questions at any time, and that will really help to, first of all, you're not gonna forget your question, but also then speed up the question time at the end. So it's again an honor to introduce Professor Altman, the inspiration behind everything we do at Wiserfunding, and really, Ed, a pleasure to have you with us as usual. So without further ado, Ed, the floor is yours.
Thank you very much, Gabriele. Hello, everyone. I'm coming to you from Eastern Long Island at this moment, and I see the list of registrations from all over the world. So thank you very much for listening in. And we at Wiserfunding are absolutely delighted to be with you today. My talk today is really on two subjects, and both of them, or each of them, probably I would need 45 minutes each. So obviously we can't do justice to both of them. I'm going to spend most of the time in my first discussion on the credit cycle outlook. Where are we in the credit cycle? But let me say a few words up front about our new research on global zombies, an alternative type of resiliency. For those of you who are interested, we will have a more detailed, somewhat academic type paper that will be sent to you as well about global zombies and how we deal with that. A very important subject. The media has picked it up. It is one that a lot of people are discussing. And, ironically, it's a form of resiliency. These are, next slide, please. These are companies that are basically insolvent, but they're still functioning over a relatively long period of time. And therefore they are, in a sense, resilient. It's not the positive resiliency that so many of you have heard about lately, particularly in downturns. And since many of us think we are headed toward a downturn, either a drop in GDP or indeed a recession, and an increasing amount of financial distress, it's very important to focus on those firms that will survive. the resilient one. But at the same time, there are an increasing number over the last 30 years of firms that could be classified as zombies. What are the appropriate measures so we know what a zombie firm is? For how long do those measures have to be in place? And how are the zombie firms supported? By whom? By banks, by governments, by investors, both debt and equity, etc. So this is the subject that I'm going to come back to, if there's time, in more detail. Maybe we can go ahead and show one more slide, Gabriele. Go further. I want to show one slide on the United States issuance of zombies. Keep going. One more. That's it. This is the United States. We estimate that there are about between 9 and 10% of listed companies listed now that qualify as zombies according to our dual filter approach, both interest coverage and Z-scores, as we'll get into. With that background, and maybe to whet your appetite for more words about zombieism, and perhaps later on we'll come back to that, let's go now to the really important subject about the credit cycle. So go ahead to slide 14, and we'll continue from there. Okay, so I've written a number of papers on COVID-19 and the credit cycle. The more important aspect today is the outlook. Next slide, please. Now, the background for any discussion of credit markets is the amount of debt in the system. This is a standard slide that most countries look at with respect to the 4 major categories of debt in our system: non-financial corporates, government, the financial sector, and household. I'm more focusing on the non-financial corporate sector, both in terms of not only how much debt is out there, but as a percentage of GDP. The bottom line is, ever since 1997, we have had an explosion of private and listed debt, high-yield bonds, leverage loans, and more recently, and Julie Miecamp is going to talk about this, the incredible increase in non-bank private debt. Bottom line is, we've increased from $22 trillion globally to over 80 trillion. And now non-financial corporate debt is about the same amount as global GDP, when it was only 64% 20, 30 years ago. So keep that as in a background. Government debt has increased, financial debt increased a lot before the crisis, and now household debt, which was the cause of the crisis in the US that spread to the world, is also a big question in some countries. Next slide. This slide shows you a remarkable increase in non-bank debt for non-financial companies relative to bank debt of late. More than twice as much non-bank debt has been issued in the United States, and you'll hear more about Europe soon, compared to bank debt. And that ratio is increasing, especially, as Gabriele mentioned, banks are cutting back on lending, particularly to what their estimate might be more risky borrowers like SMEs. Next slide. We, like a number of other institutions, forecast default rates. These are the 3 techniques we used: an actuarial technique and 2 market measures, yield spreads and distress ratios. Next slide. At the beginning of this year, a number of us who forecast on default rates, were crazy enough to do that because it's a very challenging exercise, were looking at the high yield bond market. And the consensus at the beginning of this year, if there is a consensus, was a little under 2% default rate. Some as low as 1%, by Fitch, and some as high as 2.5% of Standard & Poor's. The overall consensus, a little under 2% as a default rate for 2022. Historic average, 3.3%. The next slide will show you more about these averages. Next slide, please. This slide shows you the incredible volatility and deterioration in credit markets, first in the US and in Europe. Bottom line is, high-yield bond returns are now more than 10% negative. As of the beginning of May, it was minus 8%. It's about minus 10.2%. That's not as bad as the stock market, as Gabriele mentioned, but for high-yield bonds to be negative 10% when they're having a high coupon is quite remarkable in a short period of time. And at the bottom, you could see that the spread on high-yield bonds at the beginning of May was around 4%. In other words, 4% as a risk premium over the risk-free rate. That has expanded in the 15 days of May so far to about 4.7%. And so we see an incredible increase in the spread. But what does that mean about the future of the credit markets, default rates, recessions, etc.? Next slide, please. This is similar data for Europe. Bottom line is that the return on high-yield bonds in Europe is also now probably close to minus 9%, and it was at the beginning of this month of 7.5% negative. And the spread on high-yield bonds at the bottom there in the European market was around 4.5%. And so indeed, the markets are pricing in a much more negative scenario, but as the next slide will show, next slide, please, there may be a big shift in the credit cycle. The US high-yield bond market, with losses more than 10% at this point. The yield on BB bonds, that's the most credit-worthy of the junk bond area, now exceeds 6%, the highest since early in the pandemic, when, of course, the market had its biggest downturn. The yield on CCC bonds, the most risky corporate bond category, now exceeds 11%, more than an 8% spread over treasuries. Distress ratios have spiked, although still below average. Bond defaults, still low, but much below average. So this is something that is very interesting. At this point, the credit cycle would be signaling a benign situation with respect to defaults and recoveries. But here is perhaps the most sensitive indicator that we look at, and Gabriele inferred it as well. The new issues, the amount of liquidity in the market have stalled of late. Now about $55 billion in the US year to date, down 77% from last year, and way below the record years of 2020 and 2021. New private non-bank debt has somewhat filled the void, as Julie will talk about. They are less sensitive, it appears, to the business cycle, to the outlook, than perhaps the public debt markets like high-yield bonds and leveraged loans. But I'm thinking that this area will also begin to show a big drop in new issues as the credit cycle perhaps turns. And here's the bottom line. We think the credit cycle may have reached an inflection point from benign to mildly distressed. Reason is liquidity has dried up dramatically. Defaults are beginning to pick up, but for 2022, we forecast will be still quite a bit below the historic average. 2023 is a different situation. Inflation, the stock market. Keep your eye on the stock market and how it impacts the credit markets. My experience has been that the correlation between the stock market and the risky debt markets has reached an all-time high of perhaps 0.8. For those of you familiar with statistics, that's an incredibly high correlation. And the catalysts that drive the stock market, inflation, and you'll hear about the war in the Ukraine area from Volodymyr. GDP expected growth, interest rates, of course, inflation being so important. All of those are pointing toward a much riskier situation, and that's why the stock market is down as much as it is. And with that very high correlation between the stock market and risky debt, we can expect continued stress in the markets. So I'm predicting that very soon it'll be clear, if not already, that we are no longer in a benign credit cycle and we are mildly distressed. I am not pressing the panic button and saying we are in a crisis. We are not. Most of the indicators that point to a crisis are still saying green rather than red. However, things are changing dramatically. Perhaps I will end by the last slide. Some recent observations. Well, most of this has to do with the pandemic, so I will skip over most of them because that's pretty well known by now, the amazing turnaround in financial markets up until the beginning of 2022. 2022 now is a very different story. At the very bottom, I'm going to refer to something we're going to come back to, global zombies. These are insolvent companies, many of them with subsidies from governments, either in the form of direct lending or in the form of interest rate subsidies, or even banks making interest-only loans so they don't write off the credits. These zombies continue to exist. We will pursue, perhaps later today or in our own minds in future discussions, whether or not zombieism is a serious issue for an economy or one that we need to tolerate. For example, we may want to tolerate zombieism because the more zombies, the less unemployment. I think that's a false hope. Most of the discussion should be on the misallocation of resources from to non-productive firms if zombieism continues. Bottom line, before I quit now and turn it over to our next speaker, is the issue of the trend in zombieism. When I come back, I'll show you some graphs that show that globally, I'm talking about the 30 largest countries in the world, aggregated by our measure, the amount of zombies for listed companies has gone from 1.5% to about 7% in the last 30 years. It may not sound like a large percentage, but it's a dramatic increase as our economies become much more used to financing companies through risky debt markets. With that, I will now turn it back to Gabriele to introduce our next speaker.
Thank you, Ed. Thanks. Amazing, very interesting as usual, very important starting point for this discussion. And as you mentioned, we are really delighted to have Julie today with us from Reorg. And I think, Julie, you will cover more the European part. So without further ado, thanks a lot, Julie, for joining us. The floor is yours.
Thank you very much. So you're right in saying that I'm coming to this following Professor Altman's intervention. I'm mostly going to focus on Europe, and I'm going to actually give an overview of a corner of the market that seems to be resilient in the face of crisis. It's interesting we're having this event today because we had another pooled leverage loan transaction in Europe. This is after a bond was pooled. So clearly there is some inflection in the credit market where issuers are starting to say, no, the conditions are not right for me to issue debt. But the corner of the market I'm talking about, the direct lending and the private debt corner of the market, is still flourishing. So I'm going to go essentially to my first slide. I'm able to move them, which discusses how much debt has actually been raised in Europe over the past few years, and will show that there's been consistent growth, maybe not so consistent, but growth certainly in the direct lending market in Europe. This is how much debt has been, fundraised in Europe over the past, few years, since 2015, when Deloitte started putting their alternative lender deal tracker together. Essentially, we're now close to 44 billion of debt being raised with a view to actually invest it privately. What I think is interesting also in this chart is that the number of funds hasn't necessarily grown in this market. So when I'm saying that we have a fragmented market in Europe, I mean a number of things. First of all, there's geographical breakdown. Deals in France, in Europe, in the UK, in Germany, or in Italy, or in Spain are not subject to the same law and regulation. And in the future, if we're talking about an inflection in the cycle, they may not be subject to the same restructuring law and logic. So that's something to take into consideration. The other level of fragmentation of the market in Europe for direct lending is that you have very large funds like Ares and Blackstone, Barings, able to raise very large funds and able to deploy a large amount of capital. But you also have a lot of much smaller players who are really just supporting tiny SMEs with their business. So I think it's important to have that picture in mind before we move into like a wider overview. I'm trying to get to the next slide. The next slide essentially highlights again the three largest geographies for direct lending in Europe. Unsurprisingly, they're the UK, France, and Germany, where the vast majorities of deals are being seen. I would also say that, it's not to say that Italy, Spain, the Netherlands, and the Nordics are quiet. They're very busy, but they're just generally smaller in scale. So I think that's an important thing to bear in mind, because most of the money that is being raised is being deployed in those three markets. And interestingly, and I will come to that later, the UK, although it's one market with one currency, there's a flourishing sterling market in general, which is something that is interesting, because if you go into the high yield bond market, for instance, you always hear investors complain about how difficult it might be, how illiquid sterling might be, and so they prefer to have a deal in a different currency. You don't obviously have that issue with illiquid debt. So sterling is a strong market for direct lending. The reason why this market has been resilient over time is that it's perceived as safe. The debt that is being provided by funds to borrowers and SMEs is generally stronger in covenants. So you would never actually find covenant-like deals for smaller sized businesses. And that's something that creditors have appreciated, essentially. It's flexible and bespoke, so companies have actually liked the fact that you can interact very easily with a fund. You don't have a ton of intermediaries. It's easier to get the financing that suits your business for its needs, if that makes sense. So in that sense, the sort of flexibility element has played in favor of direct lenders. And of course, we were talking about return earlier. There's been so far a fairly constant net return of between 6 and 8%. Now, if you think about the erosion in margins everywhere else in the leverage loan and high yield bonds, which we've looked at earlier with Professor Altman's slides, 6 to 8% looks like an appealing return. So, obviously there's been more interest for funds to invest in that fashion. And I was hinting at this earlier in our conversation. Today, bonds and loans, well, a leveraged loan was pulled. Earlier this week, it was a bond. Direct lending and private lending doesn't have that kind of dynamics. It remains open, including in times of crisis. Last year, 2 years ago now, during the peak COVID pandemic problem, direct lending didn't stop. It stopped maybe for a quarter, time to regroup, and then it was actually going quite strong. So using the data from Deloitte, we could see that there was over 3,500 deals completed in 21. And again, it was pretty much a record year for transactions. It doesn't tell us much in terms of size of deals and ticket size, which is the unfortunate things with this market, where in terms of gathering data and getting statistics, it gets very tricky because there's not a huge amount of disclosure. Deloitte, for instance, compiles their lenders direct lending tracker based on funds providing the information to them. So as much as they have a fairly accurate picture of the market, they probably don't capture the full market. That's an aside. The deals that were put together in direct lending have been mostly first lien. So again, if you're a lender, your idea is to lend in a very safe manner. You have recourse, you have access, you're first lien. So if there's an issue, you come first in recouping and recovering what you've invested. A minority of deals feature covenant-like protection, and this is certainly not something that is widespread. I moderated a panel last week where it was clear that apparently in Europe, 2 funds are doing that and offering this. Other funds might eventually concede a covenant-like package because they're trying and they're competing so hard for a deal. But it's never something that is widespread and given straight off the mark. In terms of leverage, we're looking at 6 to 7 times, which might have seemed punchy in other markets and might seem punchy again if we go into a downturn. But with valuations very often on transactions going into the mid-teens, you're essentially lending with a comfortable equity cushion under you. So again, there's this perception of safety, if that makes sense. But as we discussed, with inflation being on everyone's mind, there's sort of pressure. There's pressure on return on the horizon. So, those nice return that I was mentioning earlier could come under pressure going forward. The valuations that I mentioned were quite high. It might also come under pressure, particularly now with the war in Ukraine. So there's war in Europe. It hasn't stopped business altogether. There's a number of industries in Europe that are fairly resilient. One is in education, services and healthcare. These, for instance, are sweet spot sectors for direct lenders, and they may not come under question even with a war, if that makes sense. So that has actually continued to feed the pipeline of deals so far. It's not to say that things won't turn, but so far there's been maybe a slowdown in new transactions coming up, but deals have been done. With the idea of actually pressure on return, some limited partners of funds have actually co-invested sometimes alongside GPs because, again, direct lending still is a place where you can get a comfortable return. So LPs are trying to get a slice of that cake, if that makes sense. Again, with recent developments, you could start to ask, essentially, if you're a large fund, if you're an Ares or a Blackstone, and you've been able to provide $1 billion+ type of unitranche, what could happen in a downturn scenario if a company is under pressure, it needs to go under a restructuring, and you don't want to take the keys of that business? What happens then? Do you just write off $1 billion type of unitranche? Obviously, it's a hypothetical question, and I'm not sure this will exactly be the case, but that's one of the big question marks for this market. That area of the market hasn't been tested. But we're not quite there yet. For now, what we are seeing is that the Ares and Blackstone, sorry to name drop them again, I've been able to provide large unitranches comfortably over the €1 billion mark. And they're even able, in the current environment, to come and almost rescue banks, if that makes sense. Banks who may have underwritten large transactions that can't be syndicated right now. So some underwriters on transactions like the disposal of Boots and the new transaction financing Boots, or the acquisition of supermarket chain Morrison's. Direct lenders are now being tapped and approached to essentially offload the debt of the underwriters. Now, they are not doing that for free, so underwriters are essentially offloading some of that debt at 89 cents on the dollar to direct lending funds. So that's an interesting development as well to observe very recently. I was going to also talk about the CovLite aspect, which might mean that when you get to the restructuring point, you're essentially going into a liquidity point, which talks to the theme I've raised. If you're not prepared to reinvest in your business and possibly take the keys, what does it mean for your investment in a downturn? So these, at the sort of turning point that we are reaching in this market, are key recent developments in my mind. Another recent development, less tied to the downturn, but not completely unrelated to it, is ESG. ESG regulation has been evolving in Europe since it's come into force. Some funds have been providing ESG-linked loans, which includes ratchets linked to the implementation and execution of ESG standards. That's a new development. Some funds have even hired people to focus very much on the ESG part of their portfolio. And it has led, and I think that is a positive development, to reinforce standards of disclosure when reporting earnings, for instance. But it leaves open the question of how you standardize KPIs for ESG on smaller businesses. And another point that I haven't included in my slides, but it's very real, some people have been ready to consider what ESG means in the context of a war. Is defense a taboo area to invest in, or do you want to be on the right side of history and perhaps help support, the war effort on the Ukrainian side? So these are very recent developments in Europe. I hope the slides were helpful, and maybe I'll open to the floor for questions if there are any.
We've got from Matthew Venturi. Matthew, I'm going to allow you to go on with your question, please. Matthew?
Can you hear me here?
Yes, perfect.
Hi, everyone. Thank you. Well, thanks for this opportunity to hear some great insights. I listened to some of the follow-up comments here. I did, notice we're seeing the UK bank loans decrease dramatically, which was an interesting statistic here more recently. But my question is, are these business development corps going to pick up the slack where the banks and more traditional lenders are not? And to what extent, given right now we're seeing some margin compression, we're seeing, less profitability, which will translate to less coverage ratios, lower coverage ratios. So probably some increasing default experience going forward. But I think the big overlay that we're seeing here, I'm out on the West Coast, is this lack of liquidity. You're seeing the venture funds, pull back dramatically. Obviously, the market isn't as robust in terms of this free flowing of funds. That's been really fueling a lot of these, growth company revenues, because they've had an unlimited access to liquidity to keep growing, without a lot of profitability. So, and I know we're talking about different kinds of companies, from, industrials versus technology companies, but are the BDCs going to pick up some of the slack? And to what point do they kind of run out of fuel here? Because there is this, constrained liquidity, and at some point this spigot's going to just stop. And it's been really fueling so much of this growth without really, on the margin, the kinds of historical returns on investment that people would expect based on fundamentals. It's all been, based on increasing multiples and higher valuation expectations, and it's all been, demonstrated by these crazy unicorn valuations of technology companies. So it seems like the music's going to come to an end here, and it's this liquidity constraint and inflation and resulting economic impact. So I'm just wondering who's going to pick up the slack, and when they don't, what happens?
Thanks, Matthew.
Thanks, Matt, for the question, and I think you almost answered your own question. But I do believe that there is a very important connection between the lenders and the borrowers that doesn't exist for banks as much in this private debt market. For one thing, the portfolio management of the BDCs and of the private equity firms is such that the BDCs have a lot of confidence in the supporting private equity firms. The private equity firms have skin in the game. And with the skin in the game, that transfers into a willingness to continue to provide equity capital to these companies that doesn't exist for public companies that are not supported by private equity firms. I do believe they will pick up the slack as long as those margins continue to be, like Julie pointed out, in the past or close to that. What will stop that spigot, so to speak, is the fact that they themselves will have trouble, they being the BDCs, in raising capital because of inflation and higher interest rates. By the way, one of the sources of capital for the private lenders is the stock market. It may sound strange to you to hear that. Yes, they can borrow generally at much lower interest rates than what they lend out. And so the margins are pretty attractive for the direct lenders, especially if they use leverage themselves, but extra leverage. But when the stock market and indeed the debt markets begin to slow down for them in terms of raising capital, there will be a big drop in new lending, as you pointed out, on the part of the BDCs, the business development corporations. What I found in the history of looking at credit cycles is the most difficult variable to forecast, but the most important in terms of its incredible rapidity in change is liquidity. Defaults take a while to kick in. Recoveries take a while to kick in. Spreads in the market take a while to kick in. But what kicks in almost overnight, one way or the other, is changes in liquidity. And we're all pointing now toward, at least with respect to the high yield bond and leverage loan and indeed bank lending, this is changing very rapidly in a negative direction. I haven't seen as much change in the private debt market. I think it's more resilient, it's more bespoke, and the providers of capital are much more willing, I think, to go with, supporting companies that they supported before than those other markets. However, it can change. Go ahead, Julie.
No, I felt like to answer, to give some guidance on that point, what I would say is that whenever I'm speaking to direct lenders or anyone in the market right now, I can hear echoes somehow of what I was hearing before, the 2008 financial crisis, which is we're very responsible in our lending, and yet you see 6-7 times of leverage. And then you can see valuations. Today we saw an article, we wrote an article where a valuation of 15 to 18 times for an education business, with about 30 million of EBITDA. But when you speak to people, they think all of that is very reasonable. Now that will be tested very soon, and I think what will be interesting, at least in Europe, is how do restructurings end up shaping up? Because in the US, at least, what the process is, but in Europe, you're going to have different jurisdictions treating you differently. So your unitranche in the UK, in France, or Germany will be treated differently, and that will be an interesting thing to watch, because you could argue that there is so much competition actually with direct lending funds that one could take over the other if a fund doesn't want to support a transaction. You could also argue that if you've lent already $1 billion to a business, you might want to follow up with a little bit more for a while to see if your investment can turn around. So there will be a number of very interesting developments for us, at least. I mean, I'm sure it'll be the same everywhere, but in Europe, it will be a jurisdiction by jurisdiction story.
It would be interesting to get some BDCs or direct lenders in Europe, whether they BDCs or not, their commentary on the potential turning off the faucet, as Matt Venturi pointed out. It could happen. The catalyst, in my opinion, is going to be the stock market. It's kind of ironic to talk about credit markets so sensitive to equities, but the correlation between the two has skyrocketed since the crisis of 08 and 09. When it was before then, it was maybe 0.3 to 0.4 correlations, 0.5 at most. Now it's close to 0.8. And whatever drives the stock market is going to drive the credit markets of late. And there's no place to hide. And so that could be the escalation. Any other questions, Gab?
No, while we wait for more questions, please, again, use the Q&A button that you see in the bar. Ed, we've got about 10 minutes before starting with Vlad. Do you want to go back to the zombie?
Yeah, that would be great if I have the time. Thank you very much.
Yeah.
I would like to at least give some statistics on how we look at that market of zombies and what have been the trends. So if you go back to that, will show a couple of, I think, meaningful slides. By the way, this study was a joint effort by two of my colleagues, Wei Wang and Ru Dai, one from Canada, one from Wharton. And as I said, there's a formal paper that goes into much more detail. With respect to the pros and cons of zombies, I think the main con is, the negative is a misallocation of resources that may continue to go to support companies that are not productive. Also, there's another subtle negative to zombieism, which of course doesn't show up now in 2022, but did, in my opinion, for about 7 or 8 years, and particularly in Europe. And that is the concept of disinflation or deflation. When you have a zombie company that is trying to survive, and one way of surviving, for example, is to lower your prices, particularly retail companies. Well, what happens when you lower your prices to try to increase volume? Usually, the stronger competitors also lower their prices to meet that competition. And what happens is a spiral of lower prices caused by zombie firms trying to survive. That's a subtle point that perhaps is now overwhelmed by the inflation that we're all seeing globally. But for many years, I think, particularly in Europe, let's take a company like Benetton. You know, they try to lower their prices. Well, the strong competitors do the same. My colleague, Viral Achari at NYU, has done a very careful study on this phenomena. The pros of zombieism, as I said, it might be a national interest, it might be a security type of situation, or it might be to preserve employment. How best to measure zombie firms? Next slide, please. We advocate a dual filter approach to look at firms that have the following 2 characteristics. First, cash flow coverage of interest, less than 1, based on a 3-year moving average. In other words, they don't have enough cash flows to cover their interest over a relatively long period of time. We don't think that's enough to define a zombie. although many studies have latched on to the interest coverage ratio as an important determinant of a zombie firm. We think it's much too liberal. Some countries have 40 to 50% of their companies, believe it or not, that cannot cover their interest over a 3-year period. We add to that filter firms with a clear, very high probability of default, also based on a 3-year moving average, using our Z-score or Z double prime score method. And I might point out that Wiserfunding has a new study out, and Gabriele can perhaps add some color to that study, dealing with corporate resiliency. And one of the things they are looking at are the Wiserfunding credit score of companies as a measure of the vulnerability to default and losses. And we use the Z-score. So a combination of Z-scores below 0 and interest coverage below 1 is our definition of a zombie company. Firm must qualify with both of them. And the next slide shows you our 2 measures, the Z-score and Z double prime. Some of you are familiar with it, or you can use our slide presentation to become familiar with it. You can get the Z-scores from Bloomberg, from Reuters, from a number of software programs. Basically, below 0 on a 3-year moving average is a very, very high probability of bankruptcy or default, but somehow these companies do not default by support, by lower interest rates, by direct lending, by government subsidies, etc. Next slide. This is the time series of zombie firms for the 20 largest countries in the world based on GDP. Notice that in 1990, we estimate that 1.5% of all listed companies, and I want to qualify our results, we're talking about companies that we can get good data on. The non-listed companies, the private companies, the SMEs, I'm sure the amount of zombies, for the most part, particularly if they're smaller companies, is going to be higher than listed companies. However, even listed companies had 1.5% in 1990, and in 2020 had maybe between 7 and 8%. So big increase in zombieism globally. And the next slide I showed you before looks at the United States. Next slide, please. And you can see that while there is some time series variability over time, went from around 6% to around 10% over that 30-year period. But that's listed companies. Some estimates, particularly from the World Bank, BIS, et cetera, is a much higher ratio than that, but we estimate around 10%. Next slide. The UK, the numbers are quite similar to the US. Notice that the biggest increase in zombieism was right after, according to our measure, the major downturn in the economy in 2001, 2002, similar to the US, but even more so. And the UK is creeping up now to around 12%, 10 to 12% of listed companies qualify as zombies, from as low as almost 0 in 1990. Next slide. India, for those of you who are interested in India, I don't know if any, but The Economist magazine is devoting their major cover story to India this week, so you might check out India as well. Well, they had a very high amount of zombies many years ago. As the economy has improved quite a bit since then, it dropped quite a bit, but again, creeping up to around 8% now in 2020. Next slide. These are the determinants on a cross-section basis: firm size, GDP growth, sovereign rating. A very important indicator of more zombies, ironically, is a more developed debt market. Julie, I wonder if you're thinking about that. The more developed the debt markets are, particularly high yield, leverage loans, and increasingly the private debt market, the more zombies we observe. And that, I think, is because, particularly in low interest rate periods, when investors are searching for yield, they will take outsized bets on risky companies, many of them who we think qualify as zombies, and continue to finance them in their search for yield.
If I may almost answer to you quickly, I could not agree more. You know, I think the banks in those developed countries, they just don't want to lose or recognize a loss, so they'll carry it over for as long as they can, hoping for a better future, if that makes sense.
Exactly,
And
yeah, absolutely.
that's been depressing, but that's been the case in Europe for a very long time. And we've even seen something similar in COVID, where, you know, it wasn't even the banks, or the banks were even told by the states, by France, by the UK, you know, that they had to be friendly, that they had to lend at, like, you know, to make no money or to just cover the base interest rate. So yes,
yeah, that certainly was the case before. I'm wondering how the European Central Bank is looking at those banks now, especially if we go into a major downturn. I think I'll end here, Gab, and give some time for a very interesting, anticipating that, from Volodymyr on the Ukraine situation.
Yeah, and thanks Ed, for this. I've actually seen we've got another 2-3 questions there. So I know that Julie needs to go. So before she goes, I just want to thank you so much, Julie, for your insights, for your time. Really a pleasure to have you today.
It was a great conversation. It was great to be invited, and I'm going to be around for another few minutes. So if you need a European voice, I'm happy to help.
Great. Thank you so much, Julie.
Thank you all.
And that's great. Vlad, a great pleasure. Both Ed and myself have been hosted by you a few times in the many events you organize. You've been very active. Obviously, you were living in Ukraine until not long ago, but as we know, everyone knows, unfortunately, the situation has changed. And I think it's great to get your perspective of what's happening, how resilient has been the banking system there, and what do you see in terms of trends that this war is bringing to Europe. Vlad, a great pleasure to have you with us.
Hello, everybody. First of all, I would like to thank Professor Altman, Gabriel Sabata, and their teams for this invitation. In fact, back in 1996, I started my career in risk management just with applying Professor Altman famous models, especially models for the emerging markets. So today, it's a really special day in my life to speak together with Professor Edward Altman, with Gabriel Sabata, and their colleagues today. Yes, I am from Ukraine, and unfortunately, I think Ukraine now is a country that experiences the highest level of distress. And I was asked by Edward and Gabriel to give this brief overview of what's going on with the banking system in this country. And correct me if I'm wrong, but many people in the world expected if the war of this scale started, Ukrainian banking system would work for a couple of days and then, how it's to say, go for holiday. And luckily, the reality became a little bit different. Sorry. The banking system of Ukraine is operational, and it's a big surprise, I think, for many people in the world. And in this presentation, I try to explain what are behind this operational and active position of the banks in this country. Next slide, please. And to do that, I need to probably give a little bit a look in the history, what preceded the war. And I would like to draw your attention to two major developments. First, in 2014, 2018, we had a really serious radical banking reform. So there were introduction of ultimate ownership disclosure of the banks. It was a reform on corporate governance with a special role of the supervisory boards. It was a strong move towards the implementation of Basel II and Basel III as a part of association agreement between the European Union and Ukraine, and where all key risks were addressed, including liquidity risk with LCR, with NSFR ratios. It was introduction of the IFRS accounting standards and IFRS 9 in particular. And the recent developments, it's an update in the BCP. It's a business continuity planning of the banks and the central bank. And the heavy stress tests were undertaken by our regulator. It's one component. The second component is digitalization. The digitalization of the economy in the world, including the banking system. And it also happened in Ukraine, especially COVID was a sort of facilitator of this process. And mobile banking became widespread in Ukraine. Remote identification and verification of the customers is also became available with Bank ID as a special project run by the central bank. And even the government service that used to be quite bureaucratic now also moved to this digital time. And we have a special smartphone application where you can, in remote mode, you can use some state services and receive some supports, financial supports, and also open the accounts in the banks. Next slide, please. And as a result of these two developments, we have that about half of the banking system was liquidated, in terms of the number of banks. So all these banks, maybe it's also we could call them zombie banks. They went bankrupt. They were liquidated by the central bank. The largest bank in Ukraine, Privat Bank, maybe you had this name, it was privatized. Now it accounts for the 90% of the total banking system. It was put a strong control over the money laundering, on the lending to the connected parties. It was a big problem in our old, so-called old banking system. And finally, risk management and proper risk management and corporate governance started its implementation according to the roadmap. On the left, you see the chart from the central bank as risk indicators for the whole system, banking system, was developing during these 6-7 years, moving from red to blue to normal. And it was just really, we came to the rather healthy banking system. And now we have 69 banks before the war with a historical record profit. And total assets not too high, but still it's 65 billion US dollars. With high liquidity and with the development of the economy and banking system. Next slide, please. But the war that Ukraine faces now is not the first war. Back in 2014, I think you remember the time that Russia already invaded our country. It was resulted in the annexion of the Crimea and occupation of the parts of the eastern region of Ukraine. And during that very hostile time, some banks had to relocate their operations, their IT infrastructure, their personnel from the eastern part of Ukraine to the central and west. And here on the right, you see the interesting case. It's one of the largest private bank in Ukraine, First Ukrainian International Bank, that had the headquarters in Donetsk, in the eastern part of Ukraine. He had to do this very quickly to move all the facilities, personnel, made the IT relocation to the central and to the eastern part. And all this was just supported with the development of the new versions of the BCP, this business continuity plans of the bank. And when the active phase of this war reached at the end in 2015 with the Minsk agreement, so even since then, the Ukraine, our country, maintained the military front with constant shelling from Russian proxy and deaths among the soldiers. So for us, you know, it was a time from 2015 till now, it was a time of the really very serious preparation. And now, please, next slide. When the war started, these BCPs of the central bank and our commercial banks, they were just put on the table, and they started the implementing of these BCPs, these plans of continuity of business. So first of all, the central bank introduced some controls on the FX and the market and regarding the capital outflow. So there is some restrictions on cross-border transactions, but still there is a possibility to import some critical goods, critical services that needed for the country to defend itself. It was a reduction of the requirements on the capital regulation. So the implementation of Basel III and Basel III was postponed. No regulatory action against banks that fails with some prudential normatives was also introduced by the central bank. The central bank, and together with commercial banks, so they had a backup of their ITs to the reserve sites. The head offices of the banks were relocated, even from Kyiv to the western part of Ukraine. Some senior executives moved to Poland, to other countries, and just managing the banks outside. It was allowed for the bank to keep the databases and their IT infrastructure in the cloud. That was also very good decision, very timely decision. And for example, to let the private individuals their access to their finance, so it was allowed for retail chains, to shops, to supermarkets, to allow the customers for cash withdrawals from their banking cards. To prevent panic, also it was introduced a daily limit of cash withdrawal. It's about $3,000. It's inside the country. 3,000 country. It's possible to withdraw from your cards if a person just is abroad, outside the country. But per month. And also, it's also very, very strong and very convincing move. It was the introduction of the guarantee on the 100% of the deposits of the private individuals, compared to just up to $7,000 it was before the war. To support the lending, so the central bank recommended banks to use the credit holidays, so allowing the customers not to pay interest on their loans. The government introduced the guarantee on the loans on the critical industries with risk sharing mechanism. I will touch upon this a little bit later. And for some segments, like SME segments, it was a specific program, credit program, with a 0% interest introduced. So at this moment, we have the SEP, it's the name of our interbank payment system. It's operational. 26 hours per day, 7 days a week, and the transfer from one bank to another takes up to 20 minutes. And for example, for me as a private individual, also, if I want to transfer some money from one bank in Ukraine to the other, it will take, I would say, a couple of hours, the same day, for sure. Plastic banking cards also working fine, both in Ukraine and outside Ukraine. And on the next slides, I will give you some more details of the dynamic on what's going on. Please, next slide. In addition to these two major developments, like a bank sector reform and digitalization, I must also draw your attention to the third, and I think to the third one. And this one is very crucial. As one chief risk officer of our banks put it, the most valuable asset for the banks during these 3 months of the war was the personnel of the bank that was committed to keep the banking system up and running. It's not only just the people on the bank. It's, I must just tell that it's I see it's across all segments of the population. So most of the Ukrainians are very committed to defend the country in every possible way, if not in the armed forces, but just trying to keep their businesses up and running, or paying the taxes, not waiting for the deadlines, but paying just after the end of the reporting periods. It's also commonplace. And here, compared to Russia, in Ukraine, we have a lot of horizontal connections, horizontal influences. So we don't need to get the order from the top to do something. For example, our company, it's a very small consulting company, and we assisting banks for more than 20 years, for banks in Ukraine and the banks in the region. And on the 11th of March, it was 2 weeks after the start of this full-scale war, we arranged this conference for the banks, understanding they need to coordinate their efforts, they need to exchange their experience. And it was fully our initiative, and it was, we had about more than 130 participants from the senior management and middle management of the banks. So let's move on, and I will try to give you some more details on the developments. Next slide, please. Here you see how the branches in Ukraine are open right now. So on the 6th of May, we see that 79% of all branches are open. It's 3,000, more than about 4,000 outlets across the Ukraine. And you see this different colors of the zone, how it goes. Next slide. Deposits on retail side on the left and corporate deposits on the right. You can see that the green line is growth of the retail deposits. It's let's say current accounts, not term deposits, but still in local currency. But you see the growth, and we have reduction in the deposits and current accounts in foreign currencies. Corporate deposits also, it's a flight to the quality with the moving of the funds from local banks to state banks and to the banks with foreign capitals. Just for your information, in Ukraine, the state banks accounts for about 1/2 of the banking system, and the international banks, it's another 30%. Next slide. In terms of the loans, we see the big drop in the loans to the private individuals, but the corporate loans, it's on the rise, and the roughly for these 3 months, the banks lended about $1 billion US dollars, and with the strong support of the governments. The 2/3 of that it was lent for the agribusiness because it's a sow campaign and this money was needed. Next slide. And unfortunately, of course, the first quarter, it's statistics from the central bank. It was a reduction, fell in the profitability. So the bank got a little bit of loss because of the huge loss in March. But still, the recognition of the NPLs, it's still just on the agenda. We will be expected. Next slide, please. And the next block is how the war impacted the Ukraine and what was the bank response. Next slide, please. Here you see the situation in March versus April. And if in March 10 regions of Ukraine were under occupation, that accounts for 55% of GDP of the country in the past. In April, end of April, it's only 6 with 20% of GDP. And according to the statement of the central bank, they expect that this year, 2022, the drop in GDP would be up more than 30%, unfortunately. Next slide, please. Here, the agri sector. Ukraine is one of the largest agri producer and exporter. And again, the situation is not far from to be bright. 20-25% of sown winter crops are under occupation. Another 10% just only recently released. The key problem is the blocked marine ports, so it prevents us from the exporting the grains and other commodities. The agri companies facing the input deficits and increase in production and logistic costs. Physical losses of the assets and minefields, it's also the big problem. Ukraine faces the huge labor deficit. More than 6 million of the population left the country due to these hostilities. Next slide, please. Here, it's very interesting statistics from Privat Bank. Privat Bank, I just remind you, it's 20% of the banking system in Ukraine. And here you see the decrease, huge decrease in terms of the payments in volumes and quantity from March 22 compared to the last year. And see in April, the growth not very strong, but still we can see this growth. And compared to the 32% of the companies that stopped their operations in March, at the end of April, it was only 17. Next slide, please. Here it's for you who want to dig a little bit deeper. It's just statistics on the payments from Privat Bank by industries. It's also interesting. I will not just spend too much time. You can receive these slides after the webinar and you can research them. Next slide, please. And how the banks reacted to the behavior of the borrowers. In February, end of February, up to 100% of all borrowers received this credit holidays. So did not pay anything. But in May, the situation became different. Only 30 of these borrowers still did not pay. The worst time was between March and April with 35, like NPLs. How bank reacted? So they started to just keep talking to the clients. All corporate clients were contacted. SMEs and private individuals were also contacted, just selected of them. So banks running these client surveys wanted to know what is the business plans, what is the situation with assets, what is the situation with relocation. So they just in constant link connection with their clients. They combine portfolio and individual approach. They focus less on the financials. Of course, it would be not relevant, but mostly on the repayments. And this risk sharing initiative of the government, it was a very supportive, and the banks, most of the loans, especially to the critical industry that you just see also in the slides, are supported by the government, like 50%. Government takes just responsibility of the loans. Next slide, please. And of course, the war in Ukraine cannot be just easy for the global economy. It became another, facilitator, another factor that adds the uncertainty to the global economy. Next slide, please. Here, it's also statistics on the share of Ukraine and Russia in the crop export. And you see, for example, for the sunflower seed oil, so it's about 78, about 80% of the export. So, and for many countries, especially in the developing worlds, I know that they heavily dependent on this supply from Ukraine and from Russia. And now, because of these problems with exports, they would suffer. The same could be with some other commodities. And my next slide, please. It's already presented in the Financial Times the impact of these shortages on the prices, on the commodities in the world. In addition to the agri commodities of Ukraine, also oil and gas became the big problem. So at the end, please next slide. It's a final slide. I thank you for your attention. I'm ready to take your questions, and really, we highly appreciate all you and your countries who supporting Ukraine in this fights for democracy and the rule of law in the world. Thank you very much.
Thank you so much, Vlad. Thanks. A very interesting presentation, this one. And the way you started is exactly what I thought. Like when a war starts, I would think that the whole banking system would shut down, or as you say, go on holiday. So it's quite impressive to see the response there. So very, very interesting. So thank you so much. I'm conscious that we are running already late. So I want to see if Ed is still there, Ed, and if there is any additional question. Vlad, there's a question there for you in terms of stress testing. You mentioned stress testing that banks have started to do since 2014. Very interesting question here. Was also a war one of the scenarios that was included?
Yes, thank you for this question. And it's as soon as we had the first war with Russia in 2014, 2015, no, it was obvious to include the scenarios that include also the war conflict. I'm not sure that this scale of war was included, but yes, we just keep in touch with banks, and for example, tomorrow we will run a conference for banks on operations, and we will discuss this BCP, and I will asked directly the central bank and the commercial banks regarding what extent of this worst scenario was considered. But my understanding is that it is, yes, at least the partial conflict regarding the eastern part of Ukraine. That is now is just a factual situation of the status of the war.
Yeah. Thanks. Well, again, I think we have we're basically run out of time. We're 15 minutes past our closure time. So again, Ed, Vlad, thank you so much for joining this webinar today. I think a lot of important points. It seems to kind of lead us to a conclusion that something is changing in the market. Ed mentioned a so-called inflection point, where basically we are potentially moving towards a mildly distressed, I think, Ed, that's the way you called it, mildly distressed situation. So obviously we will keep monitoring what's happening, and obviously this is important for all of us as obviously individuals, but also for companies and in particular SMEs that tend to suffer more than other type of companies, and probably more quickly than others. So that's kind of conclusion here. Thank you so much again to all of you that have been stayed with us for so long. Hopefully this was interesting. We will be sharing the presentation and the paper on zombies, the last paper that Ed wrote there. And again, any comment or question, we are always very happy to receive them. So please do. Thank you all for your attention, and have a great rest of your evening. Thank you.